So this is not really about behavior, micro behavior. Most of the papers, I think all the papers here are about micro behavior. And, as I'll mention in a second, this is anything an accounting exercise. And looking at macro data, mainly. So, sort of a little bit out of left field compared to the rest of the conference. So I hope you'll find it of interest. It really looks at monetary policy in the U.S., which since the early 1980s has been actually characterized by moderation in inflation, at least until quite recently. And I first developed a new model to address this issue. I introduced a new terminology. Inflation tax on income is an old term. It's the difference between the nominal and real growth in income. This term is always negative as long as inflation is positive. The inflation gain in household wealth, so this is a new term, is the revaluation resulting from asset price changes directly linked to inflation. And this term can be either positive or negative. And the net inflation gain is the difference between the two, which also can be positive or negative. So this is sort of the new contribution of this paper. So I used a survey of consumer finances, which is done by the Federal Reserve Board, a triennial survey. And it covers the period from 1983 to 2019. And I also look at, and based on historical inflation rates, as I'll discuss some of the literature, a lot of the papers just model, different assumed inflation rates. This is actually based on historical data. And it also looks at the sensitivity of results to alternative inflation rates. And in particular, it considers the effect of inflation on real wealth growth, wealth inequality, and the racial wealth gaps. I'm not going to be able to talk about that today. So, as I said, this is not a behavioral model. I'm not interested in how households react to changes in inflation. It's really just an accounting exercise. And we'll see that the wealth effect of inflation, there's another whole literature, is more than just leverage. And because inflation also affects the real value of stocks, bonds, and liquid assets. So I just set up an accounting framework to look at these changes. And, the bottom line is that inflation has been really beneficial for the middle class, really beneficial, huge positive effect. And actually for the very wealthy as well. And, but people who do get hurt are the relatively poor people. They do get clobbered by inflation. So, but certainly for the middle class, it's really been a great boon. And, it's not really reflected in the recent election returns. Everyone, or a large segment of the population has really has a very negative attitude about inflation. And I think this may have been a factor in Trump's victory and Harris's loss. The big inflation, well, at least for a short period of time. But interestingly enough, inflation rate has really come down last few months, but not enough to affect people's perception of it. And if properly evaluated anyway, inflation really has been a big boon for large segments of the population, the majority of the population. So I wrote an op-ed piece arguing this, sent it off to the Federal Reserve Chairman, and you know, got no reaction. So I don't know. I said, you know, you should really try to, and actually one of my policy implications is that you really should try to stifle inflation. In fact, maybe you should be promoting inflation because it has all these beneficial effects. Well, he never responded. But anyway, I'll talk about that at the end if I have time. Okay, well, there is substantial literature about the effect of monetary policy on inequality in general, and even on wealth inequality, which is my particular interest. And I actually did a paper back in 1979 where I showed that inflation actually lowered wealth inequality, big effect on lowering wealth inequality. The Gini coefficient dropping from about 0.5 points. So for those of you familiar with the Gini coefficient, that's a really substantial drop. So, and this was based on data from 1970. So, and the reason is, well, at least in that paper, I looked at the leverage effect, the fact that if you're in debt, your real wealth grows, and in that case, inflation leads to big growth in your real wealth, and those who are more indebted have bigger growth, like middle class, big, as we'll see, has a big level of indebtedness, and middle-aged households, and actually, well, back then, whites actually gained relatively to non-whites. That has changed in my current period. And homeowners with mortgages are the biggest gainers. So, that had a big effect on reducing wealth inequality. And then there are, I don't know how much time I have to really go through the literature, but I'll just mention a couple of papers like Demansky et al. In 2016. Most of these papers, by the way, find monetary policy having easing of monetary policy having a negative effect, or let's say a positive effect on wealth inequality, that's raising wealth inequality. Particularly in this paper, it was because of rising bond prices associated with low interest rates. Next paper by Lenza and Slate. I think that's a misspelling. Slakelot. Found that quantitative easing compressed the income distribution, had a negligible effect on wealth inequality. Next paper by Bunn et al. Found that the overall effect of accommodative monetary policy in the UK was equalizing. The effect was rather small. Greenwald for the US found that the long-term decline in real interest rates led to a strong uptick in wealth inequality. that softer monetary policy led to greater growth of wealth for higher income families. So you can see most of the literature actually finds quite the opposite of what I find. Here's one on Finnish data, which found that the overall impact of monetary easing was pretty small on either income or wealth inequality. And then there are some articles that look at what's called the net nominal position. The earliest is by Depke and Schneider. So this is really just looking at the leverage effect. For example, in this paper, they find that the main losers from inflation are rich older households who are the major bond holders in the economy, and particularly interested in the effect of inflation on bond prices. And the main winners were middle-class households with mortgage debt. So that's similar to my finding. Anyway, I don't want to belabor the earlier literature, but just to say that most of the findings have not found that inflation has reduced wealth inequality, and monetary easing has reduced wealth inequality. So the literature to date has been very different than the findings that I will report. Okay, so let me just briefly discuss the model. Most of it's pretty straightforward. Capital asset values, and you can see that the price of an asset should be proportional, particularly for stocks anyway, with the present discounted value of, let's say, it should depend on the present discounted value of future corporate earnings, and that will rise if the interest rate falls. So this is the mechanism by which interest rates, and as we'll see, the inflation rate affects the value of stocks, at least in this model. And again, because the composition of asset holders varies by wealth class, changes in the interest rate will affect the level of wealth and differentially affect the inflation tax. I argue that the value of unincorporated business assets should also be affected by changes in the real interest rate, and tend to follow the stock market. So a fall of interest rates will produce a rise in the present value of future business profit flows, which would raise the market value of businesses. Well, for bond values, bond values increase when the interest rate falls. The relationship is analytic, can be calculated directly. So basically, the formula is, well, you can see it's given by.
It won't work.
What?
It won't work. It's a screen.
Ah, okay.
One of our.
Okay, well, you can see bond values for a single year period are inversely related to the interest rate, and according to formula number 2. So again, since bonds are held mainly by the rich, this would also have a differential effect on wealth holdings in different wealth classes and therefore affect wealth inequality. Real estate values. Well, this is different. In this model, the house prices and other real estate values depend mainly on both capital gains expectations and how much their value reacts to changes in mortgage carrying costs. But generally, the mortgage interest rate tracks movements in the 10-year Treasury bill rate. So if the mortgage interest rate falls as a result of the decline in the Treasury bill rate, then the real estate carrying costs will also decline, producing a rise in demand for real estate, increased real estate prices. But those are indirect effects, and what I look at is just the direct effect of changes of interest rates on real estate values. And there's a direct connection between the two. There's a direct trade-off between home prices and the annual mortgage rate, based on the fact that as the annual mortgage rate rises, the carrying costs of a house also rise, and therefore the affordability of the house also rises. But this is actually based just on the nominal interest rate, not the real interest rate. So presumably a drop in the mortgage rate will also increase the demand for housing and thereby home prices. With regard to liquid assets, well, there's a direct relation between inflation and the value of real assets. But in particular, the marketable value of the liquid asset is not altered when the interest rate goes up or down. So the household balance sheet is unaffected. It's just directly affected by inflation. If the inflation rate increases, then the value of liquid assets goes down. The higher the inflation rate goes, the more the real value of liquid assets will depreciate over time. So the inflation rate comes into play in 4 ways. First, it reduces the real value of household debt, and that's probably one of its biggest effects, and also called leverage. And but it'll also lead to greater growth in mean and median household wealth. As we'll see in a moment, relative indebtedness is measured by the debt-net worth ratio, significantly higher for middle-class families than rich ones. So as a result, inflation acts as an equalizing force, reducing wealth inequality. Third, it affects the real interest rate, and that will lead to changes in stock values as well as bond values. And of course, it affects the real value of liquid assets. So this paper really looks at these 4 direct effects of inflation on the value of household assets. So I define the inflation gain, IG, as the difference between the value of stock holdings, STK, or as a function of R sub n, which is a nominal interest rate, minus the value of stocks at the real interest rate R. And likewise, the value of businesses at the nominal interest rate minus the value at the real interest rate, and plus the value of bonds valued at real interest rate minus the value of bonds valued at the nominal interest rate, minus the value of liquid assets times the inflation rate, INF, and plus the debt, household debt times the inflation rate. So that's my measure of the inflation gain in household wealth. Okay. And that's on the wealth side. On the income side, the inflation tax is given by there's something wrong here. Oh, yeah, it's given by household income times the inflation rate, INF. So that's typical definition of the inflation tax. And the net inflation gain is just the difference between the two. So as I noted earlier, this can be either positive or negative. So for those who know the economics literature, there's an old concept called the Haig-Simons concept of income. So this is very similar, which they defined as the sum of consumption and the change in net worth, including capital gains. So my notion of the net inflation gain is quite similar to the Haig-Simon concept of income. Okay, better move on a little bit. So this figure simply illustrates big differences in household portfolios across the wealth distribution. The middle class is much more indebted than the top 1%. The middle class holds a much higher share of its portfolio in homes, whereas the rich hold a very small part of their portfolio in homes. I wish I could point with this thing. Liquid assets a little bit greater for middle class families, and big difference. Whoa, there's a weird figure there. And stocks should be about 26% of the assets held of the top 1% is held in stocks, and only 5.6% for the middle class. By the way, these are based on what I call consolidated wealth accounts, where the individual components of wealth held in mutual funds and pension accounts, like 401ks, are distributed across the individual asset classes. So mutual funds and 401ks are broken down into their underlying stock and bond components. So there's a big difference in portfolio composition. Rich also hold a much higher percentage of their portfolio in unincorporated businesses, plus other real estate. Almost half of their wealth is in the form of unincorporated businesses and other real estate. Even greater Okay, so I better move on quickly here. So what's happened with the inflation rate? Well, big upturn in the 80s and a fair amount of moderation. So this time series is before the big run-up in 2022. But inflation has really moderated since the early 1980s. So what happens to bond nominal rates? Again, they peaked in the early 1980s, and then they've actually been coming down pretty sharply and pretty continuously since the early 1980s. And interestingly, the real Treasury bond rate is a trend quite similar to the nominal Treasury bond interest rate. Again, very high in the early 80s and then, fairly continuously down. I'll just concentrate on the last column, the 1983 to 2019 period. So you can see the nominal value of bonds. This is an annual rate of change. Grew at 1.64%. The real value of bonds actually grew almost at the same rate, 1.41%. Stock prices, nominal value grew at 0.93%. I should say this is really the present value of future profits. And the real value, just a little bit less, 0.74%. Home prices grew at an annual rate of 2.40%. Liquid assets, the nominal value grew at 0%, of course, and the real value was down by 2.5% per year. And the inflation rate averaged 2.5% per year over this period. So, when you start to work through the effects of these different asset price changes on the household portfolio, you can see that in terms of mean net worth, the total change was 12.3%. Mainly because debt, the real value of debt increased by 23.7% due to the leverage effect. And this was offset mainly by a decline in the value of liquid assets of 17.2%. So the total change was 12.3% on the wealth side, or $39,000 in dollar terms. The inflation tax in dollars was $42,600. So actually the net inflation gain on mean wealth was actually negative, minus $3,600, or 4.1% of median income. So mean income actually shows up with a negative net inflation tax. On the other hand, median net worth shows up with a very positive net inflation tax. First of all, the total change in median net worth resulting just from inflation was 52.3%. So that's a huge increase. And most of it was from devaluation of debt, which by itself increased median net worth by 75.9%. And this was partly offset by the decline in the value of liquid assets, 26.7%. So the inflation gain on the wealth side, median household gained $42,700 in terms of value of their wealth. What about the inflation tax on the income side? Well, that amounted to $28,400. So that the net inflation gain was $14,300, or over a quarter of median income. So this is the sense in which inflation has been very beneficial to the middle class. Net inflation gain was over a quarter of their income. So that's a huge effect. Actually, on the top 1% of the wealth distribution, net inflation gain was also positive. And this is mainly due to increase in the value of stocks, businesses, and bonds. They did lose somewhat from the loss of the value of their liquid assets. But on the wealth side, the middle class experienced a gain of 2.7%, or $291,000. On the income side, the top 1% actually lost $227,700. So the net inflation gain for the top 1% was actually positive, $63,500, or 6.9% of their mean income. So actually net inflation has benefited the very wealthy along with the middle class. And what about wealth inequality? We look at the ratio of the wealth of the top 1% to median wealth, and just look, I got truncated. Anyway, just looking at the last column, you see that the change in the ratio from inflation was huge, minus 42.8. So that was strong evidence that inflation actually leads to lower wealth inequality. On the other hand, if you look at it by these wealth classes, the net inflation gain for this is the top A column, row A is the top 5%, excluding the top 1%. So it's the NW 95 to 99. So that group lost 56.2, and 90 percentiles 90 to 95 also lost 29,100. So did percentiles 80 to 90. They lost $14,200. But look at the gain for 60 and 80, that's positive again. Percentiles 60 to 80 gained 12,700. And percentiles 40 to 60 also showed a big gain of 39,900. But the group that really got hurt was the poor, bottom 40%. Their net inflation gain was minus 19,300. But that was about I think 40% of their actual incomes. Inflation has really hurt poor families, and they've been walloped by inflation. Now, the reason why the top percentile gained from inflation and the next 3 or 4 groups lost was because top 1%, had a very high wealth to income ratio of 23.5. So even though the leverage effect was very small for the top 1%, their wealth to income ratio was so large that the net effect, net inflation gain, was actually positive for the top 1%. But these other groups had very low wealth to income ratios, so it wasn't enough to offset the income losses from inflation. What about higher inflation rates? So these are just simulated. Anyway, just looking at the bold figure numbers. So the base case is, this is looking at median wealth. Net inflation gain is 14,300 at historical inflation rates. But if you go up to an 8% inflation rate, shown in the last column, then the gain was even higher, 16,400. So higher rates of inflation are actually beneficial to the middle class. It increases their net inflation rate. Okay, well, I'm just about running out of time. So, the major findings are that inflation boosted the real income of the middle wealth quintile by an incredible 2/3. But the bottom 2 wealth quintiles got lashed by inflation, losing almost half of their real income. Inflation also boosted mean and especially median real wealth growth, substantially reduced wealth inequality. I didn't show this to you, but also lowered the racial and ethnic wealth gap. And these effects are magnified at higher simulated rates of inflation. So what's the bottom line? Why are we trying to dampen inflation? Why is the Fed trying to dampen inflation when this has all these good effects? Well, you might say, well, look at the poor. The poor got really hurt. But I don't think the Fed is really interested in what's happening to poor people. I think they're more interested in what's happening to the middle class. But we can get around that problem if we. So I wrote Fed that they should be promoting inflation, not trying to dampen it. And if their concern is the poor, well, we could actually, policy description, we can actually promote inflation and then have a special inflation tax credit. It's my policy proposal. So it's like the earned income tax credit. But each year at tax time, the IRS could compute the annual inflation rate and then provide a credit to poor families who lose out from inflation. So this would offset the negative effect for poor families of inflation, but would certainly capture the benefits of inflation for the middle class. So my time's up, so I'll leave you with that idea. Okay, thank you.
for asking me to discuss this paper. And so let me start by giving you a brief summary of what I think is happening in the paper. So the paper asks a very topical question, especially with rising inflation rates. So which is like, how does inflation affect household wealth and wealth inequality that we observe in the economy? And so the net effect that inflation has on household wealth is like the difference between a wealth effect and an income effect from inflation. And so the wealth effect emerges because of a revaluation of assets that we observe in the economy, and this kind of ambiguous effects on household wealth, depending on the composition of the household balance sheet. The income effect, which is the reduction of purchasing power, is always negative, right? It always lowers the wealth of people in the economy. And so what the paper does is really to estimate this net effect of inflation, and then it finds that inflation slightly increased the wealth of the super rich, but it significantly increased the wealth of the middle wealth quintile, and it reduced the wealth of the bottom two wealth quintiles. And so because it was much more increasing the wealth of the middle wealth quintile than the wealth of the super rich, it actually led to a reduction in inequality in the economy if we measure inequality by the ratio of the income or of the wealth of the wealthies to the median wealth. And it was like inflation was always negative for the bottom two wealth quintiles, essentially because they have so little wealth that the income effect is always dominating the wealth effect. And so let us briefly think about the wealth effect, because I think the income effect is very so there's like a middle class person that I'm gonna think of as Anne for this example here, and Anne has some assets on the balance sheet and some liabilities with which these assets are financed. And so Anne has a principal residence in which she lives. She has both some stocks and some unincorporated business interests, and some other assets. And so while the exact numbers are of course like made up, right, the proportions are taken from the data. So they kind of reflect true proportions in the economy. And on the liability side, Anne is financing her assets with debt, and the difference is net wealth. And so she has like 37% debt on her balance sheet, and so she's relatively levered up. And so let's compare Anne to someone who is super rich, and let's think of the super rich person as Elon. So he owns the same assets as Anne does in different proportions. And on the liability side, you see that Elon in this example, right, has like less debt, and especially is much less levered up. So this is like on total debt over total assets is like 2.3% for the super rich, but it's like 37% for the middle class. And so for the example, right, let's assume that all assets are real assets, so when there's inflation, their values don't change, while debt is a nominal asset, so this gets devaluated when there's inflation, right? So what's then happening if there's like 10% inflation? Well, we see a change in the value of debt for both the middle class and the super rich, and because the asset side does not change, the net wealth for both is increasing. And so this increase, because Anne is much more levered up than Elon, is much more significant for Anne than for Elon. So Anne's net wealth in this example is increasing by 6.3%, while Elon's net wealth is increasing by 0.2%. And so this really leads to a lower wealth inequality here in this section. And so this is kind of a relatively well understood leverage effect. But then what the paper is really trying to, or doing, is kind of take the asset side of the balance sheet serious and think about how is this affected by inflation, and how do we think about the revaluation of assets that the agent also move in the economy. And so this is essentially an empirical question for which the paper uses SCF data over a long period, almost 40 years, and measures this inflation tax, which is the inflation rate times the household income, and the inflation gain, which is essentially the difference of the asset values at the nominal rate and at the real rate. And then there are the relevant balance sheet items are essentially the ones that I've had on the previous slide as well. And so I overall learned a lot from reading the paper, and so I encourage you to have a look if you're interested in. So I have some very naive questions, and as a disclaimer, my research is nowhere close to the paper's focus, so they might be hopefully not entirely off topic, right? But they just come from a different angle. And so my main questions are, what is the counterfactual that we want to think about for this exercise, right? Like, do we expect, especially over this long time period, to have some equilibrium effects? And I heard you saying that you don't care about like behavior and how agents in the economy react. But I'm just wondering whether we need to take this into account when we want to say something about wealth effects over such a long time period. Then I have a naive question about how do we measure the inflation tax, and if I have time, I want to briefly talk about heterogeneity that we might want to account for in this exercise. So first of all, the sensitivity, so the analysis that you're doing, and also the sensitivity analysis, essentially relies on counterfactual inflation patterns. So if you compare asset values at a nominal and at a real rate, you're essentially setting inflation to zero to value asset. However, we would expect in almost all frameworks that agents in the economy actually react to changes in the inflation. So we have some evidence that higher inflation leads to more unemployment in the very long term. So it changes the labor market participation decision of people or the economic conditions. We also have some evidence that inflation affects the consumption and savings decisions of households, so the asset compositions that they are holding. And this is a very recent paper by Schnorfel, Wacker, and Weber and Hacketa, where they especially look at what happens if you educate people about the wealth effect of inflation, and they document quite sizable reactions in the consumption and saving decisions of people once they learn about the wealth effect of inflation. So I think this might be relevant to think about in the context of this paper. And last, we of course also have some evidence that shows that higher inflation leads to reduced economic growth, and therewith might again have repercussions to the asset values that we observe in the economy. However, it's not only like these kind of agents that react to inflation, but it's of course also central banks and monetary policy that react to changes in the inflation. And especially relevant, I think, for this paper is that we have evidence, strong evidence, that shows that monetary policy affects asset prices and stock prices in a very significant and non-trivial way, and that, like, especially in recent years, monetary policy also looks at asset prices to inform and guide their monetary policy decisions. So there seem to be like relationships between the interest rates that we are eventually observing and stock prices that we are having in the economy, and they of course have wealth effects, and they are very large and they operate with strong legs. So we might want to think about this if we think about how does wealth change with like over inflation cycles. We might want to take them into account. Last, something that I was like thinking could be interesting. So it's actually, does the source of inflation matter? And here on the left side, it's a bit hard to see probably. So this red line is the 10-year yield, so it's 1 over bond prices, while the blue line is, you can think of this as stock price levels. And so the upper panel shows you bond prices and stock prices and levels, while the bottom essentially is in differences. And so something that you see is up until 2000, approximately changes in stocks and bond prices were negatively correlated, and after 2000 they became positively correlated. And so in a recent review paper, Schiedlack and Pflüger think about where does this come from, why does this correlation change, or did it change at some point? And what they're essentially saying is what matters is the source of inflationary pressure in the economy. So if you have an inflationary demand shock, then this leads to a decline in the real value of long-term bonds, but to rising stock prices, so you get negative correlation. While if you have like an inflationary supply shock, then you get a positive correlation, and both decrease after you have changes in inflation levels. And so I think, like, because this again affects the balance sheet positions of agents in the economy, right? You might want to think about the sources of inflation also in this economy. So in the end, it's an endogenous object of the equilibrium. And so one suggestion, which might be outside of the scope of the paper, could be to think about like how do you conduct this analysis within a Hank model. And even if you don't want to do this, then I think it could be helpful, especially for like uninformed readers like me, to think about like what might be the consequences of these effects for the measures that you are taking into account, right? Do we think of them as like an upper bound or a lower bound? And I don't have a gut feeling for this. My second question was, how do we think about the income effect of inflation? So if I got it correctly, then you model the income effect as today's income times the inflation rate. So it takes this year's annual income times the inflation rate. However, human capital and income has bond-like features. So one alternative could be to put human capital like a bond on the balance sheet of the households in the economy. And so, for example, if you think that someone is earning Y dollars over 20 years, right, and this is like a very safe income stream, then you can just discount this income stream and you have the present value of the agent's future income. And so this present value fluctuates quite a bit with changes in the discount rate. So if you discount a constant income stream over 20 years at 2%, you get to about 17 times the income. While if you discount the same income stream at 5%, you get to about 30% of the income. And so this difference here is about 4 times the income. And so this magnitude is actually quite sizable, because if you compare it to the assets over the before tax income, then up to about the 75th percentile of the wealth distribution, their assets are essentially below 4 times their income. So this change in the present value of the human capital is as sizable for them as losing essentially their entire assets. And so taking this into account might potentially also like quantify the effects that you observe in the data. And so, for example, one conclusion from this might be maybe inflation was not a boon for the middle class, right? If it was like wiping out a lot of the present value of the human capital. So then, very briefly, I thought there's some further heterogeneity that you might want to think of, and maybe this is accounted for, and then I didn't really see it. One is you can of course like think about like the duration of debt holding. I think the SCF has some information about this, and potentially an interesting dimension to think about is age, which seems to be negatively correlated with leverage in the SCF data, but it's not easily, like it's not linearly correlated with asset composition. So we typically know that the very young and the very old hold fewer stocks than kind of medium old people. And so potentially this is something that might allow you to measure effects more carefully. I have some minor comments that I might want to skip in the interest of time. And so let me summarize by saying that I learned a lot from reading the paper. It certainly enriched my understanding of the effects of inflation on the household balance sheet. And so read it. And I just wish I would know much more about how equilibrium effects may affect the findings that you are having, how we are thinking about the income effect of inflation, and how unaccounted heterogeneity might help you to get an even more precise estimate. Thanks a lot.
Respond to, thank you very much for your really excellent comments. You know, my disclaimer at the beginning was I was not looking at behavioral responses. So, you know, there's a sizable literature. I'll just summarize a little bit of it, but it does in fact look at these effects, the effects on consumption, on the labor market, and so on. So there is you know, just half a dozen, maybe a dozen papers that already do this kind of thing. So well, I should say, yeah, the general equilibrium approach effects. I think that's very interesting. I don't think any of these papers actually try to model that. I can see it being pretty complicated, though. How you model all the responses of all the various markets to inflation. But a lot of these other papers do, for example, look at what's happened to the government sector and the trade and the international trade balance and so on. So there is precedent for modeling these effects in more detail. So in a sense, my paper is much more limited because I just look at the partial equilibrium effects. So, but you're quite right. It would be interesting to try to look at the general equilibrium effects. I do like your idea about including human capital as part of the portfolio. that was a very good point, because if you include human capital and inflation picks up, assuming the real interest rate rises, that human capital is going to be devalued. So, and that was interesting. So it could really offset the inflation gains from the standard portfolio. And that was, of course, throw a big damper on my conclusion. But that's really quite a good idea. And I guess that's actually doable and might be interesting to pursue. And the heterogeneity effects, yeah, I actually did look at the age differences. I didn't present them, but and they're, you know, it's certainly on the leverage effect, it's very striking reduction of the indebtedness of age. So you get, you remember the youngest age group was under 35, had a debt wealth ratio of 60%, something like that. And the oldest age group, 75 and over, had a debt wealth ratio of like 3%. So it's very powerful when you're in fact. Plus you get variations in portfolio as well. Older people holding, well, actually it's not quite limited.